Hey, my name is Matt Marcellino. I'm an attorney here with Marcellino Moore, formerly known as Marcellino Tyson. We recently went through a name change, same channel, same people, same information pretty much. Today, we're actually doing a video blog regarding business matters, right? Most of our information that we've been putting out lately has been primarily focused on family law as well as civil litigation. Today, we're going to be doing our first video regarding business. I do practice business transactional work in addition to my family law practice, and I thought this would be helpful. So what I've done is I brought in this nice gentleman sitting across from me. His name is Richard Adams. He's about to tell you all about himself. He's the man with the money, best way to put it. But today we're going to be talking about certain things business owners can consider in the running of their business to either save money, plan for retirement, and so forth. And Richard's going to help us understand a few options for business owners to consider. Richard, hello.
Hello.
Right on, right. Can you introduce yourself? Tell folks what you do.
Yeah, absolutely. Richard Adams, branch owner of CG Financial. Been doing this now for going on 11 years, but decade in the business. Got in the business because of my mom, believe it or not. So grew up Section 8 housing with a single mom, and she just allowed me to understand that people like her still need advice. And took an internship in college. It turned into a full-time gig because she said, and I quote, "I'm going to work 10 years past the day I die." Scared me a little bit. So I took an internship, helped out mom, and then all of a sudden it turned into a full-time gig. So from there, helped out a lot of small businesses over time, speaking with educators or whatever that may be, started meeting more business owners, or business owners started asking me more of my opinion on just things outside of 401k, because 401k is where I started. And then that has more or less coalesced up into me being someone that a business owner can walk in and ask pretty much any question to, from 401k all the way up to business sales or whatever that may be. So a little bit about me.
Oh. Well, what are the, 401ks are fairly popular, or at least a common term. Everybody's kind of familiar with that terminology.
Yeah.
Do you typically see that business owners are using 401ks within their the operation of their companies?
For sure. And I think the default reason why was because everyone thought it was an access issue years ago, meaning that I have to have a 401k for my people so they can save for retirement. And my field, unfortunately, or I guess fortunately, knew that that was going to be a pretty good way to make money quick. So a lot of marketing went around that, a lot of structuring, a lot of framing. And then now you're seeing business owners jump into the 401k space pretty quickly. And even post Secure Act 2.0 rules, which you can get into here in a moment, you still see that. And either for better or for worse, you see that quite often where owners will be putting them in place either for themselves or for their employees.
All right. Maybe it'd be helpful for even me to understand. I'm familiar with the 401k. Our law firm has a 401k,
Yep.
But there's other options out there for business owners to consider. So in addition to 401k, what is something that you typically talk about with owners, and just like maybe itemize what they are, and then we'll just go through each of those.
Yeah, for sure. I mean, and not to get too personal, but I mean, you guys went from a simple IRA to a 401k, right? So a simple IRA is, I guess, simple to administer. And the biggest reason that you see a lot of business owners start there is if you have under 100 employees, it's a really good way to give access to a retirement plan. You don't have a lot of optionalities, but you can get something in place, a very reasonable match where it's not going to become super expensive to you as an owner, and there's nothing to administer. So you don't have the end of the year 5,500 work. You don't have to go through all this compliance testing and stuff. Basically, the simple is just there. So that's kind of the step below a 401k.
The simple IRA, though, so I'm going to make it real. I'm going to talk to treat me like a 5-year-old. So 401k, you can only contribute, I think it changes. It feels like every year. Right now, you can contribute up to how much?
24,500 if you're under the age of 50, and then there's other rules post the age of 50, but up to the age of 50, 24,500.
So 24,500. And then with a simple IRA, what's the max you can contribute to that?
I want to say this year it's around 13,500, but to your point, it always indexes up year over year.
Okay. So there's a difference as to how much you can contribute.
Correct.
And are they both pre-tax or are they post-tax, or?
It could be either. So you can have a Roth component, which is post-tax. I'll pay my tax today, but not in the future. Or pre-tax. I don't want to pay my taxes today. I'll pay them in the future.
Okay. From the business's perspective, right? So that's kind of the employees will contribute up to X amount of dollars that they're comfortable with. Why would a business want to use, aside from it being a very good employee benefit to offer, why would a business offer a 401k or a simple IRA?
I'll give you two different answers. One, the applicable answer to a business owner should be, I want to either provide a benefit or I want to legally down the fairway do some tax planning with my own income.
Okay.
I think that would be for simple or 401k. That's where it should start. But the conversation really never starts there. Depending on who you sit in front of, you're going to be fed. Unfortunately, there's never a lie, in my opinion, but the omission of truth at times and the omission of facts will steer you in one direction or the other. Keep in mind, most 401k advisors or most advisors, period, do not get paid on simple IRAs.
Mhm.
So that's why it's such a foreign concept. Typically, I think a owner should start at simple and ask themselves, how much tax, how much income am I looking to avoid year over year? And start there and build their way and graduate up like you guys did. I
Mhm.
think what you did should be what you should do, but you very rarely see it. But it should be of how much income do I want to defer first? How much taxes do I want to legally avoid? And then build on top of the benefit and stack on layers of complexity as you hit certain benchmarks within your business.
Okay. So let's say that a company has followed what we did, because it
Yeah.
sounds like we're brilliant, right? Started with a simple, then they
Sure.
moved to a 401k in the future, and now they're operating with a 401k, right?
Yep.
There's tax reasons to do that. Same, it's just you've kind of already gone through that, right? Taxable deductions, whatever
Yeah.
it might be, and so forth. Then you have a 401k. Great. What else could a business owner consider in addition to a 401k or in lieu of a 401k?
I mean, you could think about what they call a SEP IRA. Honestly, I would never go down that road because it's a forced employer contribution. The employees cannot contribute, and then you're contributing a percentage of income for everyone.
Okay.
It's just like the simple, but there is no employee contributions. So your employees aren't getting delayed or instant gratification. It's just a wasted dollar.
Okay.
The only time I've seen it work is when the employer is super paternalistic or maternalistic and they just want to make sure, hey, I'm making sure my people can retire. It's the easiest one of all of them to administer because it's your own money.
Right.
The other thing that I have started telling people to consider is just set up a retirement program where it's not bound by anything. Coach people on how to set up an IRA. Have them bring in that IRA statement at the end of every year and see how much they contributed. You can give them a cash bonus for doing something well. That's not regulated.
Okay.
But you can have a retirement program that kind of gives instant and delayed gratification. We've seen it with the storage facility in town. Storage facilities should not have a 401k. People would challenge me on that. There's no reason. No one's going to win. But if you have a person that's making 40, 50 grand, 30 grand, and they come in and say, hey, I put in 3 to 4 grand in this, and you give them a bonus around Christmas time, well, that's instant and delayed gratification. You're teaching great habits. So I think there's ways that you could more or less craft things that meets your mission and vision as a business.
Okay. But what are the benefits aside from the gratification and the benefits
Sure.
of the employee, right?
Yep.
Why would a business, and aside from being paternalistic or,
Sure.
or whatever,
Yeah.
why would a business want to use a SEP IRA?
Instant tax savings.
Same
Right.
as the simple,
There
same
you
as
go.
the 401k.
Yep.
I mean, similar sort of logic.
Right. And to me, the reason you don't go that route is you can have a 401k and layer profit sharing on top.
Okay.
Profit sharing works just like a simple because it's an employer contribution.
Mhm.
But if you are running a business and at the end of the year, you have net income, for instance, and you want to elude some of that tax liability, you can layer profit sharing on top of the 401k and go to your advisor or go to whomever you're working with and say, we have a budget of 100 grand that we would like to divide amongst our participants. You can have a lean towards ownership. That's 100% legal. We have seen a lot of owners lean towards, if we have a 100 grand budget, we want to see 80 grand come back to us and then everyone gets 20 grand. They're still getting a benefit and you do not have to pay taxes on that money.
So simple SEP IRA,
Mhm.
401k, and then a simple IRA,
Yep.
or SEP IRA, right? From the employer side, the business's side,
Yep.
when they contribute the dollars to these plans, does that decrease the company's taxable income?
Yes, correct. Yep.
Okay.
So if you put in $1, whatever your tax bracket is at that time, you're getting a deduction off that dollar.
Right.
It's
So
not
you're
a
planning
credit,
for
it's a deduction.
retirement, you're not paying taxes on the dollars you're putting into those accounts
Correct.
until later, depending upon how those programs are set up,
Correct.
Roth and all that sort of stuff, right? Profit sharing plan. Is it a similar sort of logic? It's just more money, right? Because if a 401k max is 24.5, right? That's from the employee side, right? The employer's not putting in 24.5 on
Correct.
a 401k. They're putting in 3%, 3.5% of
Right.
the employee's salary, right?
Yep.
Okay. So it's a less of a deduction there for the employer, but it's still a deduction, or at least it decreases their taxable income,
Sure.
right? But at a much smaller amount than what might be a profit sharing plan. Right?
Correct.
Because you just do it $100,000 that the employer might put into a profit sharing plan, which is much more compared to 3 to 3.5% in a 401k that an employer might be putting into those plans. Right?
Absolutely.
Okay, so profit sharing plan would be the next potential step up for an employer to be thinking about.
Absolutely.
Okay, and how does a profit sharing plan work?
Yeah. So a profit sharing plan, how it should work is you go to the advisor with a budget and you say, we have this much net income that we would like to offset.
What
Can
do you
you
mean by offset?
basically we have $100,000 left over.
We have too much revenue. We don't want to pay taxes
There
on
you
it.
go.
Okay.
100%.
All right.
We have this. Please help us divide this amongst our employees and us. You can prorate it, and if you have 20 employees, take $100,000 divided by 20, everybody gets an equal share. Or you can have leans towards who makes the most salary. That's 100% legal. Who's the oldest, right?
When you say a lien, I think of a lien on property.
Yeah,
That's not what you're talking
no,
about.
So it's I would say you can have a strategy towards
Okay.
whom would you like to receive this money the most? It could be ownership. It could be those that are older. It could be those that are making more. You can have a strategy around, okay, if we're going to do this, say that you and I own a business and we're going to do $100,000 and we have 6 employees. We say we're only going to do this if we get $70,000 back in our pocket. Then it becomes the onus becomes or transfers to the advisor and the team to figure out, can that happen? And those reports are pretty easy to read through to understand, does this or does this not make sense?
All right, just a couple questions there.
Sure.
So one, this sounds like the employer can come to you and say, for example, we have $100,000 we want to put into a profit sharing plan.
Yep.
And here is how we, the business, want to do it. Is there rules around it, or can I literally come to you and say, Richard, I want 70 back to me and
Sure.
30 to this, and that can happen, or is there rules that would prevent that from happening?
There are rules that can prevent it, and there are times when it happens,
Okay.
right? So, you and I being younger, right?
Mhm.
If we have a staff that is similar in age, it's going to be tougher for us to pull off that outcome. But when you go to that advisor, what they can do is if they know that's your starting point and they know that that's the desired end result, they're going to come back to you with at least something that's similar to that, or come back and say, this doesn't make sense. There's no tax gratification from the ownership to do this, right?
Okay.
Now, you might still feel philanthropic in nature and want to help out your participants over paying Uncle Sam. That's your prerogative.
Right.
But at least now you know why you're doing it, and then the tax offset that follows that.
Okay.
Yeah.
So the employer can come up with the idea.
Yes.
You ultimately will say, no, but we can get you somewhere close.
Yep.
Or this just doesn't work at all because it doesn't make sense to use the money in this manner.
Correct.
Understood. Okay. And is a profit sharing plan something that you can do whenever you want, or is it you're locked in for a period of time should you do a profit sharing plan?
Profit sharing is a lot like a light switch. You have a great year, turn the lights on. Have a bad year, turn them off. So
Okay.
you can say yes, no to profit sharing as much as you would like. I have seen plenty of businesses have a great year and profit share out 2 straight years, and then a COVID happen or a government shutdown happen, and all of a sudden, some of the revenue soaks up. It's not there anymore. You just do not do it. The question that you ask leads me to believe that, others could have heard about a cash balance plan before.
Exactly where I was going.
Right. So cash balance can be layered on top of profit sharing and the 401k.
Can a cash balance plan exist by itself without the profit sharing or 401k?
It can, but it will not be efficient.
Okay.
You will end up paying more for less.
Okay.
So you really want to layer them, and you want it to tell a story and coalesce up into a greater outcome for the ownership. I do not ever condone or think it's a great idea, although we make a lot more money on these, right? It's not a great idea to put a cash balance plan in place unless ownership knows exactly why they're doing it, how much tax they're going to be able to legally avoid, and have a clear-cut strategy of this is how we're going to fund this for the next 3 years,
Mhm.
right? A cash balance plan needs to be funded north of 250 grand or higher, in my opinion. Now, there could be some slush in there, but you really want to get about 250 or more in the plan a year for it to work.
And that's in addition to employer contributions on 401ks
And
a
profit
sharing plan.
Correct. Yep.
Okay.
So you are,
So it's like 250 plus that hypothetical 100,000 we're going to put into the profit
got
sharing plan, and then there's also 401k contributions.
correct. I mean, you are looking at a strong service field typically. Like if you're looking at cash balance, profit sharing can be anything from a small manufacturing facility to 5,000 people. I get it. Cash balance, you typically want to be under 30 to 40 employees, or you want to be massive and you have the revenues to support this, because people can find me on this. It can be smaller than a 3-year commitment, but it's the easiest way for the IRS to go, hey, I don't think that was a retirement plan. I think that was a tax avoidance tool.
Okay.
And if you go and look at why Capone went to jail, it was never because he did things wrong. It's because he didn't pay taxes. So that's where you have to be very hesitant.
Then why is a profit sharing plan permitted to be just 1 year? What's the difference between the profit sharing and the cash balance?
Yeah, so cash balance was built on a pension strategy. So the pension plans back in the day needed to be funded in perpetuity because you have what they call a PBGC, big, acronyms here. The reason the PBGC came into effect was because pensions were defaulting, and the government had to step in and say, man, these people were really relying on this income and the Social Security. This is going away, and they gave you 30 years of their working life for this. So the government had to come in and start making some of these private companies whole. Well, when you go down the road of cash balance, you are setting up a form of a pension. There's more optionalities within it than a standard pension. But let's not get it misconstrued. That is a defined benefit plan underneath the IRS code. The level of certainty you need to have and the level of conviction behind that decision needs to be much higher than just putting in a profit sharing plan.
Right. So let's say the company does the 401k
Mm-hmm.
profit sharing, which light switch on and off whenever they want it, right?
Yep.
But it's layered. The layer on top of that would be the cash balance plan. But the cash balance plan, you're pretty much saying it shouldn't be any shorter than 3 years because it might be subject to IRS, spidey senses, right? Something's amiss here. But if you commit to $250,000 in your cash balance, is that $250 per year?
It's $250 per year.
So what happens if you don't have $250 on year 2?
There are ways that if it is easily justifiable, say that you and I set one up and our revenues just are not there, but the intent, the spirit of it was there.
Mhm.
The IRS and the government has an understanding of you weren't trying to elude it. Here, I'll give you a perfect example of where this could blow up in your face. And I'm not picking on people. It's just we have seen it in the field. Real estate agents can have a great year sometimes. And they go out and they do 1.5, 2.5 million of revenue. And then they do a cash balance plan for a year. And then it just falls off a cliff and they never have anywhere near that year ever again. The government goes, hey, you probably knew your pipeline wasn't strong enough to do this every year. That is a huge red flag. Now, if you do it and then you have a year where you cannot do it, you can justify it, and then you do it, sporadically from there, they have an understanding that you're trying to make it work. But if you go in and you have one great revenue year and then everything preceding that and then post that, and this was the anomaly and not the pattern, yeah, I think you're going to have some questions to answer that you probably don't want to have to answer.
You can pull off the $250 per year to avoid those IRS issues.
I'm more conservative than the average advisor. I'd say you need to be 90 to 95% certain that this is something that we can commit to and that we believe in and that we're going to fund.
Okay. And then from the employer side, the business side, again, a cash balance plan is another way to decrease taxable income, but also potentially save for the owner's retirement.
100%.
As well as employees.
Yeah.
But it's a way for you to kind of sock money to the side without paying taxes on it in the present real time.
Correct. I mean, you're looking at size. Typically, you want to be in that 32 to 37% tax bracket because then it's easily quantifiable how much you're saving in taxes. If you're in that 24 to 22%, I'm not saying you're not doing well. That's not the message. I'm saying that you really need it to make logical sense on the front end to commit to something like this. Gotcha. 32 to 37%, that's a healthy tax bracket. That means you're doing really well. That means that if you're saving that dollar today, you're saving 32 cents on the dollar. When you go to take it out in the future, you might only have to pay 22 to 24%. No advisor on earth can guarantee an 8% rate of return. We can try, but we'd be lying to you.
Mhm.
If that's a guarantee, kind of take that one.
Gotcha.
Yep.
Okay. So simple IRA, SEP IRA, 401k, up to maybe a profit sharing plan, and then cash balance are some
Correct.
tools that business owners
Mhm.
can consider for tax saving advantages,
Yep.
retirement saving advantages, their own personal investments,
Yep.
right? As well as taking care of employees to a large extent,
Correct.
right? Um, all right. Do you have these conversations with folks regularly?
More so the 401k and profit sharing and the simples.
Because there's less skin in the game, right? 401ks, it just sounds like the cash balance is a little bit more risky because you had like 90 to 95% certainty. I'm going to be able to put 250 in every year for the next 3 to 5 years or whatever it might be. A little scary for some business owners, but it's okay to stop at that profit sharing or even just the 401k,
Oh,
obviously,
for sure.
right? But the profit sharing, that's something I don't think a lot of business owners may be really aware of, is because it sounds like you can literally, like you said, do it this year.
Yep.
Skip a couple of years because it's not there and do it again. And it doesn't raise any red flags with the IRS.
Well, yes. And two, a lot of business owners
Again,
use
presuming we're not
bonuses.
committing fraud or anything along those lines, right?
Correct.
We're being above board, but we're still
Correct.
using the profit sharing plan as we need it rather than being required to do it for a period of minimum of 3 years.
Absolutely. I mean, where I see it fall apart is if you're used to doing bonuses for your employees,
Mhm.
and then you're going to go tell them, hey, I'm not going to give you cash in hand. I'm going to put in your retirement plan. That is a very hard conversation to have, right? I mean, think about giving your kids ice cream for dinner every night and then all of a sudden no more ice cream. They're going to get really pissed really quick. You have to be very careful and you have to figure out how you're going to formulate this messaging. It's better to do it on the front end when you're creating a plan to create a structure and a strategy. But again, that's where I see a lot of some of these plans are 10, 15, 20 years old, and these businesses have been mature in stature. It's really hard to put the toothpaste back in the tube. So if
Yeah.
you're creating one for the first time, it's a lot easier to be intentional.
Okay, understood. Last question.
Sure.
How long does it typically take to actually get a profit sharing plan up and running?
90 to 120 days if you're doing it right. You can
Okay.
rush it.
So when should you start planning for that? Like, is this like once you hit the summertime, hey, I need to start thinking about year-end planning, right? Because
Sure.
most of the time business owners reach out to you and I
Mhm.
near the end of the year and they're like, oh no, I may have too much money. I got to do something, or what do I need to do here, there, and the other?
Correct.
So if they're going to be thinking about these types of plans, it's maybe what, Q2? They want to kind of start getting ahead of it.
Q2 and a Q3, and the other reason is that your accountant does not want to be ambushed around certain times of the year, right? Your accountant will help your advisor create the best plan for you if they have the time. Most accountants post April 15th have time and they do not have a lot of returns. So they're looking for consultative work.
Mm.
If you're doing it in that summer time frame, everyone's typically slower. You have more time to make decisions and you're going to have more meetings of the minds and people are going to have the time to invest into it. The best outcomes are typically made during the summer for a forward-looking 4 to 5 month launch.
Okay.
Yep.
All right. And you get everyone's undivided attention rather than tax season attention.
Correct.
Right.
Correct.
Gotcha.
Or end of the year, we see this a lot. 12/1, people think about it. They meet with their accountant for end of the year tax planning. 12/15 happens. They said, hey, we want to rush this across the table. You can do it. But I can tell you now that you might not like the outcome because not everyone works. So now we're having to deal with vendors we might not want to deal with,
Mm.
outside TPAs that we don't want to deal with. We can go over acronyms all day. You're not going to get the team that you want. You're going to get the team that's available, and the team that's available at 12/15 is probably the ones that haven't sold through that year.
Right.
And now all of a sudden you don't know what you're getting.
That's good advice. Well, I appreciate it.
Yeah.
That was super helpful. So hopefully everyone that's watching, and to me,
Yep.
personally, because I know you and I have talked about these things
A lot.
before,
Yep.
and I've always been very honest with you that I'm like, on some of it, it's just a lot of inner workings. There's a lot of things to consider, levers here and there, and but this type of information, I think, for business owners, especially a growing business,
Sure.
is always super advantageous. So, like, my recommendation to most of my clients and even just people I consult with is, I think from a business perspective, outside of the owner and the employees and the business itself, the three most important people in order, I believe, are, no offense to you, the CPA accountant,
Yes.
right? Followed by the financial planner, you, and then the lawyer's number 3, because I'll draft all the stuff y'all need to accomplish what we're trying to do here. But I am the lesser of the 3, but still important. but it's, at that point in time, you have to have that discussion. My recommendation for business owners is to always have that discussion with the lawyer, the CPA, and the financial planner. Make sure everyone's on the same page, accomplishing the goals in a timely and efficient manner. But having this type of information is huge. And hopefully this has been helpful to the folks at home that are watching this. Signing off real quick, this has been one of our longer little podcasts, but I think it was really helpful.
Sure.
I think it was, and I think people are going to enjoy this one. But stay tuned. We've got a few more coming back with Richard regarding some other things that business owners can consider with regard to tax planning and maybe buy, sell, because that's always a big topic of discussion, right? And we'll maybe do that one in the next podcast. But I appreciate you coming out, Richard.
Yes,
Thanks
sir.
so
Thank
much.
you.
Yep.